Where are you at since you decided to quit your job and go all in?
Investors live and die by the one property that I pick. It's a roller coaster.
Talking about short-term rentals here. How are you deciding to pay back your investors?
So for the joint ventures, it's a long-term game. I can buy out an investor if I want to, or they can buy me out if they decide they don't want to work with me at any time.
Providing a good guest experience. Where do you draw that line?
There's going to be guests who are just scammers, who will plant things in your house, take pictures, send it to Airbnb. Airbnb doesn't have a burden of proof for guests like they do for the host.
Disclaimer here, not legal advice, right?
Yes, exactly. Not legal advice. This is actually a really popular model here in the States that most people don't even know. It just looks like a normal Marriott hotel. I have some very ambitious goals. So
your exit strategy.
Yes, exactly.
How did you teach yourself all of this? That's a good starting point. All right. Welcome everyone to the Hospitality Edge podcast. Today, I'm super excited to have Drew Pierce, co-founder at Sage Vacations, here with me. Drew, how are you today? Thank you for taking the time.
Absolutely. I'm doing excellent. Thank you for having me.
Yeah, absolutely. Drew, why don't we start by you telling us a little bit about your background? How did you get into short-term rentals? How did you go from the corporate world into, being in business for yourself?
Sure. So I've always wanted to be an entrepreneur ever since I was a kid. So for me, that was always the end goal. I had always, every time I was picking a job, it was always just to kind of set me up to like, okay, I was always just thinking this is temporary type of a thing. And while I was I was an employee in sales at Bamboo HR at the time. I purchased my first investment property out there. And the reason why I did that is because just my wife and I at the time, we always talked about like one day I'd be, this mythical place where it's like one day I'll be rich kind of a thing. And I'll just buy vacation homes and I'll get someone else to manage them for me. And we went to a place with another family and we just had a great time there. And we saw what they did at that Airbnb and just kind of thought to ourselves, you know what? We could do this. Why don't we just, we could easily just we saw what worked and we'll just do that. So we went and I just did a whole bunch of research, find out what was the best place to invest in at the time. And at that time it was Gatlinburg, Tennessee. And before I was even really savvy at market research to finding out, where's the best place to invest, that name just kind of kept popping up. And so in a lot of ways, we kind of got lucky with that place. I mean, I ran the numbers, made sure it was a really good ROI and all that type of stuff. But, I just kind of went off of what other people were seeing as far as like what was a good return or a good place to invest. And then the job I had at the time was good, but I didn't have any a lump sum of cash I could use to buy investment properties. So that's where my business model came from, is I had to go and find a way that would convince investors to put up all the money and make it so that they would and then trust me to take care of it and that they would make money. And so that's how transition there. So I just went, and once I had one property, two properties, I think once I had either my third or my fourth property, I had enough money at that point to where I didn't need to work my corporate job anymore. And so then that's when I quit and just focused on this business full time.
Love it. Just a few questions there. Did you like at which point did you go and raise capital for the first time? Was it from the first deal, or was it only when you realized that if you wanted to keep buying more and more, your capital was limited, and therefore you decided to open it up for investors? How was that process of growing from just investing your own money to now opening it up for investors to also come in alongside with you?
So I actually started it with other people's money to begin with. I never actually had a proof of concept starting with other people, starting with properties I had invested in. And so I just had to put it in a way to where my skin in the game kind of came in the back end. So what I told them is, okay, if you put up the money up front for us to get the property going, we'll have some shared expenses. So the essential cost will split. things like the mortgage, the utilities, that sort of thing. But any maintenance or major repairs on the property, I'll pay for that myself out of pocket from the profits from this thing. So that way, and also if it goes negative, I'm not going to come ask you for money. I'll take that money out of my own pocket. So that way, the worst case scenario is there was a ceiling, or not a ceiling, but a floor to how much money they could lose. Essentially, they knew that it wasn't going to be this bottomless pit to where they invest once and then that's it. I'm never coming back and asking for money again for the same property. That's how it got started.
Interesting. And I want to elaborate a little bit more on that, capital raising structure of yours and how that has evolved with time. But first, I just want to go fast forward to today. Like, what does the portfolio look like today? You know, where are you at since you decided to quit, your job and go all in? What has been the journey since, and where are you at today?
Sure. So now it's a mix of me managing other people's properties and me doing the same and joint venture model I was just describing. So I have roughly 7 properties that I've purchased on my own myself, and then I manage about that many as well of those other properties. So it's a mix of everything, and the management side is actually starting to grow organically quite rapidly.
And it also becomes a good way to generate cash flows that you can then go and reinvest on the real estate acquisition side of things, right?
Yeah, and it's proven to be a good model for me to kind of do a mix of both, because it helps me in both areas. Because the benefit of the management side of it is that there's no downside almost for a property manager. The homeowner pays for everything with it. Like, I don't have the burden of making sure the mortgage is paid for and paying for the repairs on the place and all that type of stuff, like I do with the joint venture ones. But the joint venture ones has a higher ceiling, right? Because I'm not just earning a 15% commission instead. And also I have a lot more creative control over the place. When people invest with me, they know that they are passive investors. And so I have full control over how the business is managed, how the money is spent, what the themes are of the property. There's a theme, for example, that type of stuff. And the advantage I have also was starting off with the model that I had in the beginning with the managers, with becoming a property manager, is everyone sees the success of my other properties. And that's how I haven't even done much of anything to grow that side of the business. Like I said, it's just growing organically. They just see how well my properties are doing. And then they reach out to me and say, hey, can you do this for me too? And the advantage I have with that as well, I keep referring to, is that I can tell people I'm in this with you as well, because they've all been burned by other property managers where they don't seem like they care or they know what it's like to be a homeowner kind of thing, to be on the other side. And so with them, I can tell them, like, look, no, I know what it's like. I'm in your shoes as well. And everything I do for your business, I do for mine as well, for my own homes. So like the same housekeepers I have for your house are cleaning my houses as well. So it helps in that way, to where it's like I actually understand the business, and they trust me to make sure that I'm taking care of them as well. And I can see kind of where the weaknesses are in their business and how they can improve revenue, whereas a lot of managers can't. They're operators, basically. They're not.
They don't have the perspective of what it is to own the place and have a mortgage that you need to, cover, and, the stress that can come with it when there's seasonality or unforeseen expenses. You can truly have empathy for all of those kind of things, right?
Right. Well, and it's just busy savviness as well. It just helps you with it, because, for example, a lot of these people come to me, they say, like, yeah, my last property manager was trying to get me to drop this 3 or 4 bedroom house to just $65 a night as the minimum price. Like, I lose money at that price. Like, there's no way I'm going to be profitable with that. It doesn't make any sense. And so I can work with them and develop a strategy about how we can, how can we change things? How can we lower your expenses? And also, how can we increase your revenue?
Absolutely. Yeah, because a lot of times when we're doing like dynamic pricing, but without having that investor mindset on, we're just thinking about, revenue. We're just thinking about top line. We're not thinking about what are the variable costs here, what are the fixed costs, and so it makes a lot of sense that gives you an edge. Now, going back to the structure of your capital raising, tell me a little bit more about how that has shifted and how that has evolved with time. What are some lessons that you've learned as you've done different joint ventures that has led you to whatever you do currently? Or is it the same that you the way you're dealing with capital raising right now? Is it exactly the same that you were when you first started?
No, it's evolved over time. So when I do joint venture stuff, it's still the same issue, the same thing, but there are issues associated with it. Then this is why I'm switching to a different model slightly. So as of right now, investors live and die by the one property that I pick, unless they have more money to invest into multiple properties, which many of the investors I work with don't. They're giving me their last $100,000, for example, and so, like I said, they live or die by that one house. And so, if it's a slow month, they really feel it, and if it's a good month, it's a roller coaster. They're in cloud nine. And so what I'm doing now is eventually I'm going to be rolling the properties that I have with joint ventures into a fund, so that way those are all the investors that are in it are all in it kind of together. So that way, and they're in multiple markets, they're diversified, and overall I'm still working out the kinks with that, but make it so that they are making more money in that model as well. And I'm moving away from that as well and moving more into, like I said, funds and syndications as well. So like right now, as you know, I'm working on a glamping project, right? We're just in the final stages of that. And what I love about that is just the margins for that are really, really high, where we're not getting that right now in like the traditional Airbnb market, right? Where you just buy a single family home or a condo and then you rent it out on Airbnb. Glamping project has a much higher ROI. And so we're able to shift into that, and I'm able to do group funding instead of rely on just one investor and rely on that. And I found that it's really just as easy, if not even in some ways easier, to do this than to find a single investor to buy a single home with you. It's easier to pool money together.
Okay, so you're basically acquiring the land, and then from there you're structuring it, putting the tents in place, whatever needs to be put in place for the glamping format to be viable. Is that more or less how you approach it? Like you buy the land?
Yes. So I already purchased the land. So that was the first step, and then I approached investors and said, we already own the land. This is how much it's going to cost to get into it, and this is what the expected returns are going to be, and it'll be something I've never done before, which is a waterfall syndication, which is more complex than my previous models have been.
Can you tell us a little bit about two things? First, when it comes to your personal education around capital raising and syndications, and you talked about waterfall structures, which I would like us to also break down here in a minute. How did you teach yourself all of this? Because there's a lot of details, there's a lot of things that you need to be compliant on, you need to be aware of regulations around capital raising and whatnot. Can you do just public solicitation or not? Do you need to work with only accredited investors or not? How did that education process go with you in your case? Is it all self-learned? Did you participate in any kind of like masterminds or anything like that where you were given somewhat of a blueprint? What was your approach when it comes to education about everything capital raising and syndication related?
Yeah, so it's not as scary as people think it is. It's like any other business venture you want to go into. You just add an extra zero to the end of it. So I learned everything that I did from both current investors and from attorneys with it. And it's so like from the attorneys, I learned that for the first, I don't remember the number now off the top of my head, something like 40, 45 investors don't need to be accredited in your fund or in your business. So they don't need to be accredited of any kind. Anything beyond that, they do
Yeah.
need to be accredited.
Disclaimer here, not legal advice, right?
Yes, exactly. Not legal advice. So talk to an attorney to confirm what I'm telling you. And then I actually learned the syndication from someone who was interested in investing in the glamping project. And they're like, why are you doing it this way? Why don't you do it like a syndication? Doing like this, and this is the way I'm familiar with it, and it makes me comfortable. So I learned from him, kind of how it is, and it took a really long time. And I actually, what's funny about it is that before I was saying this, that it's actually not as complicated. When I was first getting started learning this, he was trying to explain to me. I thought, I'm not smart enough for this. The people who are doing these syndications are way, like, I don't understand how this works. As it felt like he was talking in circles, kind of thing, to explain it. And then I realized afterwards, I did a little bit of research on my own. He was kind of talking in circles. I found He was contradicting himself, and he was just trying to explain it in the way that makes sense to him on how he understands it. And so the way that it works, according to my understanding, and so again, for everyone to listen to this, if it doesn't make sense to you, maybe a quick Google search and someone else will explain it to you that makes a little bit more sense than the way that I'm doing it. But it's almost like waterfall syndication. So you imagine there's multiple waterfalls that need to fill up a pool of water. So on the very top, right, there's a pool of water, and it has to get to a certain point, and then it flows over and fills up a second pool of water before it flows over into the third and final waterfall. At least that's the case in mine. They can get super complicated, like 9, 12 waterfalls, and it seems like it's very unnecessary. I like to keep it simple as much as I can. So mine's a 3-tier waterfall. And so how that works is, the first thing is you have a preferred rate or a hurdle rate. That means that the investor is going to get a return on it that's not necessarily guaranteed, but 90% of the money that comes in is going straight to the investors until they reach that threshold. So it could be anything from like 6% to 12%, for example, just depending on what stage you're in and things like that, or how much you invested with it. Okay, once they reach that hurdle rate, let's say for just simplicity, it's 10%. Okay, once they get 10% return on their investment, then it overflows into the next one, and again, that's until the pool fills up. That's just going to keep going, and that second pool, at least in mine, again, they can all be a little bit differently, but with the one that I'm doing here, is that's where they get the return on capital. Okay, so in other words, if they invested $100,000 and they got and then they got their 10% return, well, they have to get a full $100,000 back in addition to that hurdle rate that they got. So really, they're getting a minimum of a 10% return on it. They're not just getting their money back. So, but then once that fills up, and it may not fill up in the first year, right? In like 99% of the cases, that's not going to fill up in the first year. Okay. But once they do get their return on capital, you just kind of imagine that waterfall gets washed out and it goes into the third waterfall. Okay. And that one is where it's a different split. That could be anything from a 50-50, 60-40, all the way up to 90-10. Everything. Like I said, it just depends on what the general partner is offering.
Yeah, you're at the end of the day, you can negotiate all these terms, right? You can negotiate the splits at each one of these steps of the journey, right? If you wanted to start with something.
Yeah, it depends. Like for me, I just set very generous terms, and then I don't negotiate with my investors because I don't want to start the relationship off by having different rules for different players. So sure. I just offer something that I feel like is very generous.
Makes sense. No, I mean, as a syndicator, you can come up with your own
right. So in the syndication, right, they're called.
Yeah,
exactly. So if you, Sebastian, created your own syndication, that would make you the general partner. And you're right. As the general partner, you can decide what all those terms are. That makes sense. And you just want to go off of kind of what's normal in the industry so that people who are familiar with it kind of know, like, you're not offering something that's really stingy, or you're not being too generous type of a thing with it. So you just kind of know where the norms are with it. It's just like pricing for your Airbnb, right? You got to know kind of what everyone else is charging, right? Mm-hmm. So that you're at least kind of in that same general ballpark.
Yeah, let me ask you a question because in multifamily, a lot of times it happens that, well, I don't know about nowadays with all the where we're at with interest rates and whatnot, but a big part of that returning the initial capital that was given. Let's say the to go back with your example, you give me 100,000. I'm gonna give you back your 100,000, but I'm also gonna give you a return on top of
Okay.
that. Sometimes that 100,000 that I'm gonna give you back is gonna come from a refinance, right? It's gonna come from me having increased the NOI, going to the bank, then
Mhm.
refinancing it, and then giving you back with debt essentially what you had given to me. And then there's cases in which that puts you out of the equity component of the deal, and then I just keep paying you just like an interest rate. Other cases where you
Mhm.
keep essentially being an owner, but the point is it's coming from a refinance. In your case, is all of it coming from just proceeds in terms of profits of the operation, because it's such a more cash flow oriented model? I mean, I'm talking about short-term rentals
Mhm.
here. Or are you
Mhm.
doing any sort of also leveraged essentially exits, when you're looking at short-term rentals particularly? How are you deciding to pay back your investors? Is there a little bit of also refinancing that happens, or is it all just coming from just the cash flow of the properties that you're acquiring?
Are you referring specifically to the syndication or to the
Yeah,
short-term rental joint ventures?
the syndicate. Well, maybe you can tell me how it's different between one and the other, between the
Mhm.
joint ventures and between the syndication.
Sure. So for the joint ventures, it's a long-term game. I can buy out an investor if I want to, or they can buy me out if they decide they don't want to work with me at any time. And the equity is set up in a way to that makes it fair.
So you
And
guys are like
how,
50-50 in there or something like that?
so how it works, another thing that I put it the ball in their favor is I said if we sell it or anything like that, you get your whatever equity is in there, you get your first money back. So if you give me $100,000 and there's $100,000 exactly, you get 100% of the return. Now, if there's $150,000 of it, and let's say I've put in $20,000 of my own money into it, well, then what we're going to do is you're going to get the investor's going to get back $100,000. I'm going to get back my $20,000, and then we'll split the remaining $30,000 of equity. Okay, so then the investor basically gets 115. I get $35,000. So that
Makes
way we
sense.
can all kind of it makes a win for everybody. But how it works also with leveraging the properties, because that's a big part of the growth plan, is we're not doing anything right now as far as leveraging the properties, but when it was good, we were leveraging them. And so if you have a house that has $100,000 of equity, I can tap into about, let's say, $60,000 of that equity, right, through a cash out refinance. So I'll take that and then I'll take the money and go buy another property with it. And the investor, because they financed the first house, also get the same claim to the new property. So now they have two properties without actually getting additional coming up with additional capital on the place. So it's the same
Oh,
thing, but since they didn't get put any money into the second house, right? I basically now become the first position where I get my money back, and then we split the remaining 50-50.
okay, so that's the joint venture structure.
Yep, that's the joint venture
Basically,
structure.
if we sell, I'll give you back what you put in. I'll take what I put in, and whatever is left, we're gonna split 50-50 or whatever the arrangement was. That's
Correct.
joint venture structure. What about now syndication?
So the syndication is we're not. I don't. What I'm most likely going to be doing was this is the game plan is I'll have multiple syndications. So I'll have a syndication. First it's just this first glamping site that I have going up in the Smoky Mountains of Tennessee, and then I'll probably do that a few times. And then the plan will be then at this point say, okay, I can either buy you out, or we can agree to just roll this all into one glamping fund, and then we'll just roll it all together. into it, and then that way I can keep that way I can leverage, say 5 glamping resorts and to keep it growing, kind of a thing. Because that's my primary goal. A lot of people get into the real estate game with the hope that they can kick out their investors, sooner than later, so they can just do their own thing, and that just makes life easier for them, and also they get to keep all the money, all the rewards. But my opinion is that you can either have a slice of the watermelon or you're going to have the whole grape, and there's nothing wrong with either one of them. It's but my opinion is I would rather have a slice of the watermelon than the entire grape.
Yeah, no, that makes a lot of sense. So when you're looking at, you've been doing this for what, 5 years almost already, as far as being full time. Well, I don't know if full time, but I see that you've been doing this
Yeah.
Sage Vacation this thing for almost 5 years. How long since you've been full time at it?
Oh, I've been full time for some like 3 years,
3 years.
2 or 3 years.
Perfect.
Yeah.
So
So
yeah, so now it's been 3 years. Where are you spending most of your time nowadays? I mean, because you have also to look at, your investors, you have to look at deals, you have to look at what's coming next, but then you now also have the operation that's going on. How have you decided to structure yourself around that? Is it bringing in like a operations partner, or is it just outsourcing everything and just having a property management company in place? How are you looking at where you are personally spending most of your time, and what kind of a structure did you put in place so that this is actually scalable?
sure. So that's the key right there is scalable, and this isn't a plan to build it up and sell it kind of a thing. This is something I plan to have for a really long time and to build a brand with. Like I want to compete with, I want to be like the Marriott kind of a thing, or Hilton of the vacation, the short-term rental space type of a thing. I may even get into hotels and be direct competitors. But um, most of my time right now, I'm doing some remodels, so I'm doing that, kind of focus on that right now and doing the glamping resort. But when I'm not doing this, this is going to be the last time I do this. Um, my time really I just thinking about what is the 80/20 rule? Like what are the activities that only I can do that move the needle? And so right now I'm trying to gear up a little bit to where I can put a branch manager in over a couple of different locations. So, but I got to get it built up a little bit bigger so that it's actually a good living wage for them. So then they'll quit their good corporate jobs, basically, come work for me. I don't want somebody who's, inexperienced and desperate, for this position. So, just building those up a little bit, and that's going to be there. I have most of my operations are automated. So the guest messaging is automated. The housekeeping stuff is mostly automated. And I'll be outsourcing a lot of the customer support here shortly. And my primary focus will be on probably creating content on LinkedIn and really just growing the investor base that I have and focusing on projects. Just figuring out what's the next project and how do I get that done.
So in other words, it seems like you've decided to keep most of the operations in-house rather than you're going to be working with vendors here and there to outsource certain areas of it all, but you're not just giving this to a property manager. I mean, you are the property manager, right?
I am the property manager.
So
yeah.
you have that infrastructure to build. And how are you balancing in terms of, wanting to grow your investment portfolio versus your property management portfolio? How much effort is going into each of those, and how do you think they're going to be growing steadily, or do you plan on accelerating more on the property management side of things because there's no upfront costs, because it's easier to scale, less capital intensive and whatnot, and as we were saying earlier, help that to fuel the investment side of it? How do you look at the two models right now that you've been doing it for a couple of years?
So I'm really in the hospitality space. Like I know because I buy real estate, I'm always put into the real estate investor hole. But really, I only buy properties so I can manage them. So that's the whole point of like the glamping resorts kind of a thing. Is it makes great money, great margins, but it makes it so that I'm in control of the growth of my company. And so it's like, hey, I'm going to build this glamping resort. It's going to have 75 tents on it, and I'm going to be the one to manage it. So that's how I'm fueling the growth there. And when other people want me to manage their homes and assuming it fits in the portfolio, yeah, I'll take those on as well. And that's just kind of the cherry on top, if you will. But I'm building homes or developing these properties so that I'm more in control of my future. I'm not reliant on other homeowners and their whims of the day. You know, if they get spooked and say, "Oh, the economy is really bad, I'm going to sell," you know, my business can't go under because I'm the one who owns the property.
Absolutely. Absolutely. No. And you mentioned, that you're very aware you are in the hospitality industry at the end of the day. How do you
Mm-hmm.
balance that hospitality component where a lot of it is also, providing a good guest experience and going above and beyond and, making sure that the spaces that you are offering are properly designed and welcoming and whatnot. But then you have on the other side, the investor side of it, which is like efficiencies, ROI. Do you find it hard sometimes to balance between wanting to do everything that I guess would want and go above
Mm-hmm.
expectations and just go crazy to do anything that I guess could ask, because we know that they're gonna ask, and as long as we keep doing, they're gonna keep asking, right?
Sure, sure.
At some point, you gotta put the investor hat on and be like, okay, I feel like maybe enough is enough, right?
Sure.
But where do you draw that line? How do you personally balance between the two?
Yeah, that's difficult to say because, in most cases, the two are aligned. You take really good care of the customer, you're going to get good reviews. Good reviews lead to more higher ADR and things like that. So, but yes, there are going to be investors that or excuse me, guests that make you want to pull your hair out. That happens on a daily basis, and it makes it difficult. So the first thing that I do is just make sure I try to eliminate as much of the guest interaction that is needed as possible. So we create processes to make sure that we anticipate their needs. So it's like, hey, last guest or two has been complaining that there's not enough toilet paper. Let's increase the amount of toilet paper we leave in each bathroom. Just as an example. Now, there's going to be guests who are just scammers too, who will plant things in your house, take pictures, send it to Airbnb, and Airbnb doesn't have a burden of proof for guests like they do for the hosts, and then they get their money back. So what we do to help prevent that is we actually collect a safety deposit. We use Enzo Connect. Shout out to them, and Francois and his team
Also,
there.
yeah, I'm actually in Montreal. He's in Toronto, not too far. I've know each other. Yeah, we know each other.
Oh, okay, got it. Yeah, he's a good guy. Um, but anyways, they have a great platform for doing that, making it so that you have a safety deposit set up. So that way, if there's any issues with the guest, you can just say, we're kind of done with this kind of a thing. We're not even going to worry about it if there's damage, things like that. But yeah, but to go back and answer your point though, is it's difficult to say because there's no like hard and fast rule, at least that I have developed yet, that says, okay, once they've made this many requests or done this type of thing, we say no. It's almost kind of a case by case basis. And the tone of the guest, and I have to take a step back and think about, am I reading this for the first time? And is this being a reasonable request? And for me, I will take, if I can do it, even if I feel like it's not really reasonable, I will do it one or two times, but I probably won't go beyond, a second time where they ask me for anything that I consider to be unreasonable requests.
So you've talked a lot about automation, and even started naming some of those companies that you use, such as Enso Connect. How do
Okay.
you think about building that tech stack of yours, going back to the importance of scalability, and
Hmm.
what does that look like for you at this moment, and has that changed since you started, or have you pretty much been able to stick around with the first choice of technology providers that you chose from the get-go?
No, I've definitely made some switches over time. It's been painful every time I make a switch. So
It
I
usually
started with
is.
yeah. So I've started with IGMS and as my system, and it worked great. The problem is that it felt to me at the time when I started, again, this was 4 or 5 years ago, that it wasn't built for larger companies. It was really built for, like, it was free up to 4 properties and stuff like that. And then it got more expensive. Then all of a sudden it would jump up to $20 per property, and there wasn't anybody who synced up with them. You couldn't connect to them to build a website. There was just some things in there that were a little bit more limited, and so I eventually switched to HostAway. That's who I use right now as my property management system. They have a lot. They connect with everybody, like Enzo Connect and everybody that I like to use for that for the business. So I use HostAway. I use Enzo Connect, as I suggested before. They automate my messaging now. HostAway does it as well, but the reason why I use Enzo Connect is because I can also send things. It's easier to send text messages, emails. I can also use them for upselling things, like if I want to do early check-in, late checkout. They also replaced my Aperto app. I used to use Aperto, but I would run into issues with them once in a while where the door codes wouldn't load. If the door lock was offline shortly before the guest was supposed to check in, the door code wouldn't work. And it could be any number of reasons why the door would be offline. So it became a struggle, and also no one knew how to check out with it. But we don't have that issue with Enzo Connect, fortunately, with that. And I also use Wheelhouse for my pricing.
Hmm.
And let me see here. Who else do I use? I use Turno as well
Let's
for
say revenue
my.
management wise,
Uh-huh.
you use Wheelhouse, amazing, dynamic pricing software
Yes.
tool. Are you personally the one who spends most of the time overseeing Wellhouse as a platform, doing the revenue management work, or do you have someone in your team kind of overseeing that? Let's move into that team structure side of things. What does that look like right now? Who's playing the role of the revenue manager, and what kind of a structure have you put in place so that you have both the property management side of things covered, but also the, let's say, investor relations and fundraising, syndication side of things covered? What does that team structure look like for you right now?
So as of right now, I am the revenue manager. I probably won't get a revenue manager of any kind for quite a while, um, just because like a really valuable one. There's 6 figures, and that's not something I'm prepared to pay at this time.
Sure.
Is for that. There's just not. It's not worth it to me yet. Maybe down the line it will be, but my goal as of right now is I'm constantly tinkering with it. Like, part of our success has to do with the revenue management, the little things that I'm doing that makes it stand out from everybody else,
Hmm.
and it seems to be working. And so I'm trying to figure out how to make that a system that works for everybody, or for all my properties, I mean to say. So that way I can just get a virtual assistant who can just, all right, here we go, or you're the person in charge of launching new listings, and as a result, like these are the steps you're going to take. This is how you're going to set up the revenue management software with Wheelhouse to make it so that we know this is running optimally from day one.
Hmm.
And so I'm working with that system. And then also, the fundraising is the syndication is a new thing to me. So that's also me at this point.
Wearing many hats.
I wear most hats. So,
That's amazing. That's amazing. Andrew, when you look ahead and you think strategically about where you want to be, in the coming years. I mean, you talked about maybe getting into also acquiring hotels. You talked about wanting to build a brand and be like a Marriott type of brand in vacation rentals. What does that vision look like? Where do you want to be in the next, let's say 18 months? But then also, what does that look like, 5 years from now? What is it that you're aiming for, and what can we expect to see from you, man, in the coming years?
hopefully a lot. I have some very ambitious goals. so So the first step here is the glamping resort, right? That's going to be done here in 6 months or less. Okay. After that's done, I'm going to be building actually a condo hotel. I don't know much beyond that at this point. As I haven't done much research into, what market I'm going to be going into or anything like that. Like I'm pretty much focused on everything else with the business and the glamping resort first. I want to get the glamping resort up there, let that run for a year, figure out all the kinks there, figure out what I did wrong, what I did right with it, so that on the second one, it's better than the first one.
Sure.
And then we'll just keep that churning, and then I'll focus on the condo hotel.
Let's
But
talk about
honestly,
that condo hotel project for a moment. I'm curious, like,
sure.
what that, because I've seen. I don't know if it's similar to what I've been seeing lately of a model where you build something up. It's a whatever, like a hotel complex, but then you sell the units individually to investors and offer them a return, but you handle the management. Is it something like that where you're going to be selling the units independently, but you're going to be building?
That is exactly it. Yeah.
Okay.
So this is actually a really popular model here in the States that most people don't even know it because it just looks like a normal Marriott hotel, for example,
Right.
or regular Hilton. Is that those rooms? They was funded by investors who own individual units.
And then you can
So
get into
it's
fractional ownership as well, and maybe you have more than one investor in each room, right? They have the right to use certain number of nights a year,
like a
but they also
timeshare.
get the returns. Well, yeah, timeshare. But they also get the returns from certain nights. Is that part of it too? Fractional ownership, or you're thinking one unit, one investor?
No, how it'll be structured is I will be raising money for the hotel as a whole, and all I know at this point is that it's going to be a boutique hotel. It'll be something like the Great Wolf Lodge. I don't think they have those in Canada, but here in the States there's something called the Great Wolf Lodge. And what that is, it's a themed hotel that's really made for kids. It's all wolf themed, cave, woods type of a thing.
Okay.
And in it there's a little water park, indoor water park, so that people can
Oh
go
wow.
stay there year round. Doesn't matter how cold or hot it is outside. They can go and just their kids can play, and that's included in their nightly rate. And then they also have extra stuff that you can pay for, like restaurants at Ben and Jerry's, ice cream, things like that. And so
Cool.
that's kind of the model I think that I'll probably be following. Only difference is that I will be, once I build the hotel, how the investors will get their money back is when I sell the individual units. And so when I sell the individual units, it'll be anything from 1 bedroom to a 4 bedroom hotel. And it'll actually be apartment style condo hotel. So in other words, it's going to have a full kitchen, and everything like that based inside of there. And that's the route that I'm taking with it. And of course, my company will be the management company, and it'll say something, whatever hotel by Sage Vacations type of thing.
Got it. So in other words, the people that are going to be buying the units are not really like your investors. They're how you're going to pay back your investors essentially.
Exactly.
That they're your exit strategy. Interesting.
Yes, exactly.
That's very interesting. And so when it comes to, are you thinking of building, or are you thinking of acquiring something that is already built and just converting it into condo?
Honestly, it depends what's out there. Like I said, I have
Depends what you
not,
find. Sure.
and I've done any kind of research to figure out. Like I said, I got to pick a market first,
Yeah,
and then
that's a good
I
starting
will.
point. No,
So,
no,
and then I'll
but in
figure out
terms of
kind of
like,
what's available
would you be
there.
comfortable like with actually building
Yeah.
from the ground up? You are. That's very good. That's very good. And the thing with hotels, I mean, I don't know. Tell me something. When you are acquiring, well, actually no, because you started with the JV model, and that was single family properties, right? That was
Mhm.
single family properties when you were doing joint ventures.
Right.
So in there, were you doing any like when it came down time to the acquisition? Was any of it coming from traditional financing, or was all of it coming from investors? Because what I'm trying to understand is, that initial debt component to it, if there was any in any of your previous acquisitions, how is that different from a loan to value standpoint when you're looking at single family versus, let's say, acquiring the land versus, let's
Mm-hmm.
say, now if you get into like more of a zoning that is commercial hotelish, you if you go the traditional financing route, with the hotels, you end up with the loan to values that are 50% or less. No, it's the banks are going to lend you much less. So are you using banks at all, or is it all of it for you just coming from equity from investors in all your previous acquisitions?
No, so in the first one, it was a traditional loan through a bank. We used my credit score, my income, all that type of stuff to qualify for the loan. The investor just paid the down payment and for any repairs that we need on the
Oh,
place.
okay. So that was what, an 80% loan to value or something like that?
Yes, yeah,
Okay.
yep, exactly. So that's what I did on the first one. After that, I had an LLC in history, so then I started using private lenders with it because I was self-employed, and banks don't really like self-employed people.
Right.
So,
The history was
um,
what? The property management income?
yes, exactly. So you just have to be able to show that you can pay for it for 6 months, basically, this property. You have enough money in there. So if it's $2,000 a month, you know, 2 times 60, you have $12,000, in the bank. And
Okay.
if you can show that, then you can get a loan from any private lender.
Okay. So then you went with private lenders. Were the terms any, well, because they tend to charge more in terms of interest rates.
They
Um,
do. They do. The difference, they do that, but they also will only lend to LLCs. They won't lend to individuals. And so the interest rate is higher. Um, but most of the terms are about the same. It's 25% down, typically 20 to 25% down, to buy a short-term rental, and you just got to show them that it's going to make money, and that's about it. It's actually a much simpler process than working with a bank.
but are you looking at private lenders, or were you looking at private lenders as a temporary thing, as a bridge type of loan that you would eventually want to get rid of for cheaper debt?
Yeah, eventually, yeah, private lenders are good when you're smaller. They'll because when they're not super helpful. Well, they can be helpful, I guess, but they want to see like business history and things like that. So it's difficult to get it in your first property. Like any real estate investment, the first one's always the most difficult. But once you get past that hurdle, you know what you're doing. It's lenders trust you a lot more, and it's a lot easier that way. But once you get big enough, then banks are willing to give you commercial loans. And so like that's what I'll be doing for the um, my glamping resort, for example. That's going to be through a traditional bank.
And are they're not lending you, I mean, because they're not considering the revenue that you're going to be making, because they don't really, I mean, at least in Canada, you talk to them
Okay.
about short-term rentals, man, and they
Okay.
don't want to talk to you, man, those banks,
Yeah.
because they don't even look at those numbers. They don't, like, for them it's all up in the
Hmm.
air. They don't know that there's forecasting tools. They don't know that it's actually, that there's seasonalities that you can somewhat, forecast,
Okay.
and with a good level of precision. Are they lending you based on forecasted revenues from your short-term rental incomes, or
Yes, they are actually. So both. So they'll do it based upon the land. We own the land free and clear.
that
So that
helps?
that right
That's
there
it.
is
That's
is,
like your
is
down payment.
collateral.
That's
Right.
exactly your
So
collateral.
yeah,
Yeah.
almost no money needs to come out of the pocket, and the bank's going to pay for. I won't have to make any payments on it for 15 months. They're gonna, they'll finance all the tents, the construction, everything for it. So it's going to be, um, a pretty simple process. At that once we just close on everything, but they do take into account things like they hire a company, a third party who will say they do what's I believe it's called a viability report, just to see is this business model viable. And with something like glamping, there's enough, or the hospitality industry, there's enough for them to do it. But like I said, they're not going to do it for in individual small homes, it's a lot easier to go with a private lender, for the smaller projects. But when you go bigger projects, it becomes the opposite. Like you're much better off going with a bank than you are with a private lender.
And when it comes to that last model that you're going for next, that hotel type of
Mm-hmm.
project, um, I know it's too early. You first need to find the market, but would you also be thinking, let's finance this through a commercial, traditional lender?
Okay.
Because then it might get difficult, right? They're not gonna lend you that much unless you've seen otherwise. But or are you looking at private investors, private lenders as well for the hotel condo project?
No, the hotel industry here is pretty solid. Something like 85% of all travel is in hotels here still in the
Sure.
States. So we'll go through the commercial lender at that point. When it's big deals, banks want to work with you. Like I said, they don't want to work with you when you're buying a $300,000 home. They're not that excited about it. But if you say, hey, this project is going to cost me 3 million plus, then the banks are getting a lot more excited about it, especially if it's like a $30 million project, like a hotel might be. Depending on the size, obviously you can get much smaller hotels than that. But banks then become the banks will start chasing you when you have a track record and the deal looks like it's good enough, and you can show them like this is what the revenue is going to be doing, and then you can and they'll be able to run their own comps. They get the viability report, and the viability report comes back positive. It's a very easy process to do. It's a little bit long-winded, but it's fairly easy to get approved.
But we're still looking at loan to values in the 50s, no?
No, with a commercial loan, it's going to be more like for this glamping resort, for example, it's a 90% LTV. Like they're paying for 90% of it.
Okay, man, I gotta move to the States.
Yeah, yeah.
That's it. I think that's the conclusion of this podcast. Oh man, I love it. I love it. Well, listen, Drew, this has been super fun. This has been super fun. I love what you're doing. I love what you're up to. I think this was very valuable. Let's wrap things up with maybe just the last few words of wisdom and advice that you would be giving to someone that's looking to do what you've done, build a property management company, also maybe, get into the syndication game. What's something you know now that you wish you knew when you were starting that maybe would have saved you from some headaches, or maybe help you speed up the process to getting where you are now?
Sure. I would say be mindful of your expenses. When I first got started in 2019, revenue was so easy. It was just super high, didn't take much effort. And then when the economy clamped down, then I felt the burden of those expenses that I had. I was telling people, yeah, go ahead, charge me whatever you want, basically, because it didn't matter. But now it matters. And so I'd say, like, hey, just be careful with your expenses. When you refinance, things like that, you're not over leveraging yourself, none of that stuff. I would just say be conservative.
That's, yeah, very important. I think a lot of people are gonna be, I mean, especially here in Canada, because here we got financing terms that renew every 5 years. So whereas, I mean, in the States it tends to be throughout the entire amortization period. Like, I mean, there's other options for sure, but here most people that got in with low interest rates, many of them with variable rates, actually. Some of them with the
Mm-hmm.
variable rates where the payment didn't change, so now they have like negative leverage essentially.
Right.
Those terms are coming due in not too long, and yeah, it's good to go and leverage, and let's grow. But I think what you just
Mhm.
said there around, look at your expenses, make sure you can service that debt, and
Mhm.
I guess just forecast, for a worst case scenario. I think that's
Mhm.
super important and super valuable advice. So thank you very much, Drew. Thank you for taking the time. I could have you here for hours and hours because this has been a very interesting conversation. But I look forward to seeing, where you're gonna be next. I look forward to seeing the glamping project, the condo hotel project, and everything else that you have going on for you, man. Super excited for you. Thank you for taking the
No,
time.
thank you. Thank you for having me.
Absolutely, my man. Absolutely.